As Fred said, sometimes there was one paper and sometimes there are two papers. Here we have two papers on climate change, one by Bill Klein. I don't know whether I should introduce you in some way in this house. That would look very strange, no? To say that you've been a fellow with the Institute since the start, but you've moved focus. And climate has been of interest for some time, but it was not your initial field of interest here at the Institute. So Bill Klein and Randy Vegelos, who is a senior fellow at Bruegel, who also is a kind of a newcomer in the field of climate, because she was mostly dealing with innovation, with industrial organization, and has moved into climate through that angle relatively recently, after having spent time with the European Commission as a senior advisor with the President's Bureau of of European Policy Advisors. So the two speakers, and then we're going to have two discussants. You discussant Günther Hermandiger, who is an advisor on your environmental affairs at the representation of the Commission here in Washington, and James Bradbury, who is a senior fellow with World
Resources Institute.
World Resources Institute, and we are very impressed because, unlike the other members of the panel who are mostly primarily economists, you know a little bit more that what you're talking about, because you're by background a geologist, right? Okay, Bill. So 10 minutes for the two presentations.
Thank you, John. My paper first examines the Copenhagen Accord pledges and their implied abatement costs. It second considers the prospects for U.S. action in light of the recent delay of climate legislation. And third focuses on what are the possibilities for cooperation between the United States and the European Union on this issue. The first part reports estimates from a recent paper I've completed, and in the interest of time, I will highlight very quickly some of the results. First, the Copenhagen Accord, in my view, lays the initial groundwork for overcoming the single largest problem of the Kyoto Protocol, its omission of developing countries in abatement efforts. Second, I show in the paper that China and India, at the end of the day, didn't really pledge anything beyond business as usual. But if you think about it, that's an important pledge, because it means if everybody else cuts back emissions, then there will be no room for China and India to become massive sources of carbon leakage. The other emerging market economies actually committed to more or pledged more. Brazil, Korea, Indonesia, Mexico, South Africa all pledged cutbacks of about 30% from business as usual by 2020. Third, Copenhagen 2020 is just the start. In order to have 450 degrees parts per million CO2 and 2 degrees warming, you need to massively cut emissions by 2050. And I've developed what I call the Copenhagen Convergence policy path, in which after 2020 there's a linear decline for all countries from their current emissions per capita to a global average target of a global target for each country of 1.4 tons per capita in 2050. In comparison, today the United States has almost 20 tons per capita, the European Union 8 tons, Japan 10, and 5 in China. A uniform target by 2050 per capita, it seems to me, mobilizes the moral ground for calling on sharp cutbacks by countries such as China. And I don't really see any other way to do that. Fourth, the tables that you have in the handout and also in the paper, to me, the most important implication of the abatement cost estimates in the tables is that they are manageable. For example, the central estimate is something like 1/4 of 1% of GDP is the amount of cost of the abatement. By 2030, to get on this linear glide path down to the 2050 target. Now that's incommensurate with the outraged cries of how doing anything on climate will bankrupt the American economy that one tends to hear in this town. Fifth, the cutbacks from the business as usual by 2050 are going to need to be somewhat higher than what the European Union, the U.S. have pledged, 85% to 90% from the baseline. But it also turns out that the cutbacks from baseline will be a commensurate level for some of the major emerging market economies. China, Korea, South Africa will all have cutbacks that are comparable to those in the U.S. and EU because their future baseline would otherwise have been so great. So those are just some of the highlights, and for those who are interested, I could provide the underlying paper. Let me then turn to the prospects for U.S. action. The Waxman-Markey bill in June of 2009 in the House of Representatives turned out to be the high watermark for U.S. action, at least for now. The bill sought cap and trade to reduce greenhouse gas emissions by 17% from 2005, 83% by 2050. These are the Copenhagen goals. Parallel efforts in the Senate stalled in July of 2010 when Senate Majority Leader Harry Reid announced that he would not take the bill to the floor. The concentration of legislative effort on the health care reform and on financial sector reform, combined with the increasing partisan gridlock, and especially the Senate, dooms the prospects for legislation on climate action in at least 2010. Now, all the legislative proposals in the United States have had the threat that if they are not passed, then business will have to face the regulation by the EPA as the alternative. So in some sense, the legislation typically would preempt that and address global warming directly by the legislation. In 2007, the Supreme Court ruled that greenhouse gases constituted air pollutants, and they were subject to regulation by the EPA. But now that the legislative initiatives have stalled, the role of the EPA shifts from being the club in the closet to being the frontline enforcer of implementing the Copenhagen Pledge. Plan B, as you might think of it, as the alternative to legislation, also includes 3 regional initiatives: 10 northeastern states, California and 6 other western states, plus 4 Canadian provinces, and a Midwest grouping of 6 states. And together they account for about 40% of the emissions. The World Resources Institute has estimated that combined action by the EPA and state action could reduce emissions below the 2005 level by 6 to 14% by 2020. So a lot can be done with Plan B, but I see Plan B as merely a stopgap approach for the next 2 to 4 years that is useful as leverage to induce legislation. It also seems to me that climate change policy is so fundamental that it ought to be adopted on a bipartisan basis rather than ran through Congress in the fashion of the health bill and even the financial sector reform bill. Third, implications for U.S.-EU cooperation. First of all, what about fair burden sharing? There has been quite a bit of concern that the U.S. commitment to reduce emissions by 2020 only bring them back to the 1990 level, whereas Europe is talking about reducing them 20% or 30% below the 1990 level. Well, there are some reasons that help explain those differences. A major difference is population growth. From 1990 to 2007, EU population rose only about 4%. U.S. population rose 20%. A second consideration is that much of the abatement in Europe and in the EU was facilitated by the closing down of a lot of inefficient energy production in the transition economies. For the core 15 countries of the EU that were initially EU members, emissions actually rose 5% from 1990 to 2006. It was for the 12 subsequent adherents that emissions declined by about 25%. What about burden sharing with respect to per capita emissions? 20 tons per capita versus 8 tons. Well, it turns out that that's partly explained by per capita income. You'll find that the paper has a chart that shows a cross-country regression, which is emissions per capita on the vertical axis and the logarithm of purchasing parity per capita income on the horizontal axis. And the United States turns out to be right exactly on that line. The U.S. or the European Union is considerably under it. China is considerably over it, excessive emissions for its per capita income. So there is some truth to the fact that European Union is more efficient in avoiding emissions, but the difference is not as great as the raw comparison would suggest. And of course, the surprise in a sense is that European per capita income is as low as it is. We tend to think of Europe as having comparable per capita income. By the time you throw in the new adherents, it's about $28,000 in 2007 versus $43,000 in the United States. Now, what about cooperation between the U.S. and the EU? One important area, it seems to me, would be the harmonization of their cap and trade systems to allow trading emission permits between the two economies. It is, I think, crucial to establish an international price on carbon, and simply the merging of the two trading systems would go a very long way, it seems to me, to doing that. And the international price is not only important because of international efficiency, but also as a spur to technological change to give some confidence of future price on carbon. If the U.S. were to adopt legislation similar to Waxman-Markey, it could integrate trading emissions with the European Union's ETS and vice versa. The Plan B, in a sense, could also be used in this fashion. In fact, as long ago as 2006, California's Governor Schwarzenegger and the UK's Tony Blair agreed that it would be a great idea to have trading between California and the EU. Now, the other most important action that the U.S. and the EU could take to help ensure action on climate would be to make sure that the efforts at international finance promised at Copenhagen materialize, $100 billion per year by 2020. Now, that's a number that includes the sale of carbon permits as well as outright finance. If you take, in the paper that I mentioned, I've estimated the needs for finance, and if you set China aside on grounds that it has massive reserves and is not really in need of finance, then I estimate the Copenhagen convergence path that I discussed would require investment in other abatement costs of something like $40 billion a year in 2020, $120 billion in 2030. Adaptation costs in developing countries be something about, say, of the order of $40 to $50 billion. So it's not difficult to get up, especially if you put in sale of carbon permits, to something like $100 billion a year of financial flows by 2020. In summary, it seems to me the Copenhagen Accord is a good basis for beginning meaningful action by all major emitters. The United States must overcome partisan political gridlock, but the abatement costs should be manageable. It will be crucial to follow the 2020 targets with much more aggressive cutbacks through 2050. The United States and the European Union can help assure successful global climate action through cooperation in trading emission rights and ensuring that international finance for abatement and adaptation becomes a reality. Thanks.
Thank you very much, Bill. And now give the floor to Randall. Keep it in there.
Yeah. Let me first of all start by apologizing for the paper. This is really still work in progress here. I'm not so sure it's a good idea to read it at this stage. Maybe wait for the next version, as I've been working on it these last days here. So I would like to tackle the issue of climate change policy, and particularly EU climate change policy, more also from my own background, which is innovation here, and ask the question to which extent the current policies that we have, are they indeed capable of mobilizing innovation here. I'll be very short in terms of sketching the EU policies post-Copenhagen, as this is, I guess, well known here. Just like to point out the fact that we have, in terms of policy instruments in place, beyond ETS and non-ETS, also this recently, or not recently, at least since 2008, introduced the Strategic Energy Technology Plan, which is a technology pillar supporting European climate change policies here, where the idea is to coordinate policies, programs and finance for research, but also for development and demonstration of new technologies here. Important to note in terms of the European CC policies here is the impact of the crisis here, which led to lower emissions than expected due to lower GDP and higher fuel prices here. As a consequence, also the ETS carbon price has been falling too, and only recovered slightly since 2009. And also that there is still a significant amount of banked allowances in the system and unused international credits as a consequence of the crisis here. And as a consequence, the full implementation of the climate and energy package can now actually be achieved at much lower cost than previously estimated here. The target of minus 20% can already be realized by 2020 internally without the need for any international credits here. And also the non-ETS standards or targets can also be more easily met here. So that's one positive effect of the crisis here, you could say. But on the other hand, it also, the fact that we had lower carbon prices also now raises the issue of will this lower carbon price be sufficient to drive climate change innovations and technology deployment here. And this partly drives also the discussion we're currently having in Europe in terms of moving to possibility of going to the 30% scenario here. This is motivated not by the fact that we would go to 30% because other parties are more ambitious in their emission targets here. This is not the case. It's purely internally motivated here by the fact that it would now cost less because of the crisis to move to the minus 30%. It will also restore a bit EU leadership in climate change policy here. And also as an argument that if we would move to 30%, we could leverage innovation more, creating a competitive edge for European companies in low carbon technologies, which is more central in the Europe 2020 strategy here. So that really raises the issue, can Europe indeed, is it capable of activating these innovative potential and create this competitive edge for EU companies here. In order to assess this, I'm looking at the performance of indeed private green innovations here. It's not so easy because the data are not so very well developed here, but we very recently had patent data that identified very clearly what green innovations are, and these kind of data I'd like to show here. First, in terms, if you look at the trends in green patenting here, so this shows the trend in various sub-technologies here, and you see actually that green patenting had been very stable here, but it only started to trend upwards as of 1997 here, which is more or less the Kyoto Protocol area here. So then you indeed see that these green technologies have been trending up more than on average what you see in patent here. Simultaneously, you also see that fossil fuels and nuclear actually have gone down here. If you look at which technologies here, this is mostly solar PV, which is the most important technology in terms of patenting here, wind, which really have trended up, and also more recently biofuels and carbon capture and storage here. If you take a look at who's who in green patenting, who's active here, this is the average over the whole period here. You see that the top 6 countries on top is Japan. It's by far the largest and most important actor in terms of green patents here. So it's big. It's not specialized in green technologies here, but it's very much concentrated on a few clean energy technologies, most notably solar PV, which is the largest area here. The US comes in second place here. It's not specialized in clean energy technologies at all, but it's more spread in various sub-technologies of clean energy here. Germany is almost on par with the US here. It is specialized in green technologies here and also very spread in terms of different technologies here. In fourth place comes actually Korea here, which is specialized in climate change technologies here. Very much, again, like Japan, concentrated on solar PVs here. If you take a look at the BRICS countries here, they're still very small, not representing 1% of total patents in clean technologies here, but they're rising fast, and particularly China is among the fast-growing countries here, specialized in these clean technologies here, and also spread across various sub-technologies, so not only solar PV here. I'm not going to go into detail because of lack of time here, but if you take a look then more within these sub-technologies here, who's who and who's strong in which technologies here, you can really identify that this is really getting to be a multipolar green technology space here, where of course you have in all of these, the big players are there, Japan, Germany and the US here, but they're different in terms of where they're actually specializing in, and a number of smaller countries can actually be very strong in some of these sub-technologies here where they have specialized in. For instance, think of Denmark in wind here, but you also see that China is in a number of these sectors specialized and strong if you go at the level of sub-disciplines here. So just to summarize a bit the characteristics of these private green innovations here, first important point I didn't mention yet is that overall these clean technologies are only a very small share of total patents here. They represent less than 1% of all patents here, which still suggests that this is a technology that is underdeveloped here. Although we do see a growth, the growth comes only after 1997, so clearly related to the Kyoto Protocol here. And then in terms of the main patent actors here, you clearly see the big players, Japan, US and Germany, but that also Korea and China are important players here too. And furthermore, since they each specialize in different technologies here, you do see within the level of different subfields high concentration of who controls these technologies here, and differences in who specializes in what here. Where, for instance, Asia is very strong in solar PV here, while in carbon capture and storage is the US and a few European countries that are very important here. So overall, if you take a look at these patterns across time, across country and across technology, you see a lot of heterogeneity, and this heterogeneity is very often correlated with public interventions here. This is actually also what you can show more strongly with econometric evidence here, which confirms this strong link between private green innovation actions here and government intervention here. So overall, it's also what the literature suggests, it's very important for this private green innovation machine to be kick-started by government interventions here. The question is, what type of policies do you then actually need? What seems to work best for stimulating these private innovations here? That has to be a mix of carbon pricing, R&D support and regulatory options here. If you take a look at how well governments have been doing in providing these incentives here, then it's clear to see that the two main instruments, carbon pricing and R&D support, have actually been shapeless, particularly also because even if they are in place, they lack the long-term commitment and certainly also in Europe are still too fragmented to really substantially drive innovation in clean technologies here. You could ask the question whether there is a new momentum in Europe now, particularly with also the SET plan, the Strategic Energy Technology Plan here, which really wants to boost the investments in these low-carbon energy technologies from currently 3 billion per year to around 8 billion for the next 10 years here. The question, of course, is who would actually pay for this. Initially, it's mostly EU funds here for the first projects, which are in carbon capture and storage here. But in future, the European Commission wants to leverage more member states' funding, but in any case what's very critical is, will it be able to leverage complementary private funding for these projects here? And then I think a nice, interesting brain teaser here is if we would look at a private venture capital that goes into renewable energy here, that could be interpreted as a signal of the willingness of the private market to fund these type of investments here. First of all, what you see is the top picture gives the venture capital investments in renewable energy. The bottom is the general venture capital investments in total. What you see is, first of all, in the US, of course, bigger venture capital market in the EU. You also see the sensitivity to the crisis here. Big drop during the crisis, and particularly in the US. But what you see is that in the US, this has picked up now, and there is an increasing interest in renewable energy from the venture capital market in the US, while in the EU, it still continues to trend down here. And this is particularly remarkable because, on average, if you take a look at venture capital in total in Europe, you don't see this still decline here, so it's only for renewable energy here. So this, of course, it's just a fact, but you could relate it to maybe that the private venture capital market is not yet really convinced of EU policies to be able to drive substantially renewable energy here. So in terms of the main message that I would like to draw here is if governments really want to leverage this private innovation machine, they need to provide a consistent policy that combines carbon pricing, regulation, public funding, and particularly pivotal is a sufficiently high and long-term predictable carbon price. This will make any type of public funding to support these technologies here much more efficient here. So it will particularly be important for the success of the set plan here is that it needs to be supported by a sufficiently strong carbon price here. And then the whole question is, if we would indeed move to the 30%, would that be sufficient to provide a strong enough carbon price or not here? And then finally, conclusion in terms of the global coordination here. As I try to illustrate that the world of green technologies is indeed multipolar, I think we should really look beyond just transatlantic coordination here and include all major players here, particularly also the Asian players here. Those at least that are patent active Annex 1 countries should also be included here. What should be the aim of this coordination would be, and this is very much in line with what Bill Klein was saying, a single global carbon price by integrating or linking carbon markets here. But with respect to innovation, also coordinating public R&D programs here, pooling resources, opening, avoiding duplication, and diffusing results here. Also trying to work on establishing global markets where green technologies can be traded here, and then also transfer of technologies to non-Annex 1 finance-constrained countries here. So here I'm not talking about China here, which belongs to the Annex 1 patent active countries here, but the ones that are finance-constrained here. And there it's clear that we need to move beyond the CDM mechanism here, which is not the right mechanism to transfer technologies. Thank you.
Thanks very much for the two papers. They're very insightful and fascinating reminder of what we're talking about. I was going to open my remarks with the statement that climate change exists and that it is man-made. Yes, it is, and it's unfortunate that I have the feeling that I should say that, but I have the feeling I should. The EU policy is driven by that, and I think the policy of many of the majority of all the other countries in the world. And even though they are having difficulties coming to an agreement, that's not so much a reflection of their disagreement that something should happen, but of their disagreement on just how we should get there, because so much is at stake. And time is running out. From a European perspective, the policy is that the emissions need to go down. That really is what counts, and we need to get there somehow. And then there's a lot of machinery that we need to activate to get there. As has been mentioned, Europe is on track to meet its emission goals, not always for the right reasons. I mean, we didn't want the financial and the economic crisis to help us get the emissions down. That certainly is not the right pathway, even though it helps us to meet certain goals we've set ourselves. It has also been said that internationally, the basis for moving forward is the Copenhagen Accord. And that is certainly true. But it's a basis for moving forward. It's on its own. It's a starting block. It's not in itself enough. one of the things that the EU tries to achieve in the international negotiations is to bring Copenhagen into the framework of the UN negotiations, because the goal is very much a binding international deal that has legitimacy by being signed up to by all. And that answers to one of the key divisions that we see emerging here, which is emerging in other economic fora as well, but is put in contrast here, which is the division between the developed and the developing world, and how to shift the burden. And I find Bill Klein's considerations of the reduction pathway to 2050 extremely interesting in that respect, because it conveys this message of equity that I think a lot of countries are looking for in the negotiations, and that seems to be one of the roadblocks. So we see negotiations going on right now in Tianjin, which is the last time the international negotiation is happening before Cancun, the next COP meeting, about November, December this year. And I think everybody, after the experience of Copenhagen, has become very careful what kind of progress they announce that they would be satisfied with. And the word South Africa is popping up in that context. Clearly, we want to see some progress in Cancun, and we want to see that from a European perspective. We want to see that as a credible part of a step-by-step process. We are being realistic. We want a globally binding deal that involves everybody, and we want Cancun to be a step on the way there. And that includes, on the one hand, very importantly, the concept of a balanced approach, the fact that everybody has to bring something. Developed and developing nations have to bear their fair share of the burden. We want individual decisions to move forward on a number of topics, and I think in this way we see very much eye to eye with the United States. There are topics that are ripe for decision making, on monitoring, reporting, verification, on deforestation, on an international framework on adaptation, on new carbon market mechanisms, on bunker fuels. There are issues that are ripe for moving forward, and we hope to see progress there. And this seems to be something that, despite all the difficulties, could make progress in Cancun. So I'm sitting here in the EU delegation in Washington and basically watching these negotiations from afar. And I'm concerned with the transatlantic aspect of this, and how can we as the European Union help the United States get along on this pathway. We are different, but we are also very similar in a global context. We are both highly industrialized economies, both with high per capita carbon emissions. Different, but as it has been pointed out, not all that different. Both market economies. And that brings me to a concept that is very clearly an aspect of the EU climate policy vis-à-vis the United States, and that is the interest to see legislation enacted in the United States that creates a carbon market. There is a carbon market in the European Union, and of course there's an enormous interest in linking up to other carbon markets for the obvious rationale that I don't have to explain to this audience, that that's the instrument to get emission reductions at lowest cost. I have a feeling a part of the very adverse discussion that we've seen here in the United States is due to the fact that it's a catchphrase and not very many people actually know what is meant by it when you say cap and trade. It has been abused politically. One of the things that I think we should be looking for is communication channels to explain to people what that actually means, what is actually at stake. And what should also be communicated much more is just how much of an economic interest there is for entities such as the European Union or the United States to become active in this field. We've seen the venture capital investment figures. That's not for nothing. That is because people sense an opportunity here. And that opportunity is there, but it is also there elsewhere. It is there in China and other industrialized or industrializing countries. So there is an interest that we get our slice of the pie. Europe certainly is very interested in that. How do we do that? innovation-wise, innovation is one of those elusive beasts that are difficult to manage, and clearly you have to work in a multi-pronged approach. One of those is to give a stable signal to investors. And it has been argued by some that an emissions trading scheme is not a stable signal because it has a market price and the market price fluctuates, and that is true. And that is as markets behave, because they convey information and the information changes all the time. I should point out that Europe has at one stage attempted to introduce a carbon tax that was already in the 1990s, and that unfortunately has suffered the fate that most tax proposals at the EU level do, for procedural reasons unique to the European Union. Unanimity on a body of 27 countries. But we certainly do see the opportunity in innovation, and we have a policy that was already outlined to push it forward. Maybe I think I should also point out that not all impacts of emission-reducing policies immediately show themselves in the form of innovation when you measure things such as patents, because there's such a large number of things that you can do to reduce emissions that aren't innovative in the technological sense at all. Putting double glazing windows in every home is not innovation measured by patents, but it is a huge part of what we need to do. So maybe that's just the tip of the iceberg of what is happening. And as the world gets around to getting serious about climate, I would expect more of the technological cutting-edge innovation to happen, especially on the energy supply side, but also in the field of energy-saving demand-side measures. Look only at the question of electrical vehicles, for example, electrification of transport. So there is, I think, a lot still coming, and in the paper, some of the obstacles are being pointed out. It's good that they are, and we need to address them all. Maybe just one last word, and I can't refrain from that. I used to work in policy making in one specific area, and that was CO2 emissions from cars. And what I learned there is that when you talk about the costs of future legislation, you are dealing with something that is very, very elusive. You're discussing the difference between a baseline, that is your expectation of what might happen, and you compare that with the costs of something deployed massively that currently isn't actually deployed massively. And we've had that experience time and again when you compare the ex-ante cost estimates of new legislation, and a few years later you look into the ex-post actual costs that are being found. There are staggering differences. So when we look into economic models of the costs of climate change, we need to be aware that we can only populate those models with cost information that we have today. But it is only when policies are in place that the industries concerned will actually, for the first time, look in earnest how they are going to do this. And with that message, I will stop. Thank you.
James, your last panelist, please. The floor is yours.
Thanks very much, and it's my pleasure to follow those excellent remarks. I think those were really on point, and also pleased to be here. Of course, appreciate the opportunity to comment on these very good research papers, and thank the Peterson Institute for the opportunity. So I'll speak to the two different papers in the order they were presented. First, I'd say I think Dr. Klein's paper provides a very helpful point of reference or frame of reference for really where we are today in the U.S. and also globally on this challenge. And I think more than anything, to me, it illustrates our current predicament, and that it's advanced to the point where we cannot hope to prevent dangerous levels of climate change through incremental or small steps in the right direction. We really do need a sustained and global effort. This means, as I think was implied by Dr. Klein's paper, that in the U.S. we will have to use all of the tools available to us to achieve emissions reductions and uphold our commitments under the Copenhagen Accord. Those include, of course, the Clean Air Act authorities, which are really critical to achieving emissions reductions in the absence of legislation. I think, as of course the Senate and I guess both houses of Congress consider repealing those authorities or delaying those authorities, we risk very seriously damaging the sort of tenuous credibility, I should say, the U.S. has with the 17% target sitting out there for 2020. And to the extent that those authorities are delayed or eliminated, which several in Congress would like to do, I think we're deeply sort of on a precipice here. So I would certainly strongly agree with Dr. Klein in that international finance for developing countries is a very important piece of this puzzle. It's obviously an important piece of the international negotiations. Cooperation between the U.S. and Europe is a good idea. Of course, each country needs to appropriate the funds to put into the pool. And again, we'll be waiting on Congress and hoping Congress will appropriate those funds. Also agree that linking the different emissions trading schemes is a very good idea. Could be beneficial. Of course, right now we're looking at regional emissions trading schemes, and that there could be those I think could be linked to the European system. It's been very frustrating, of course, to watch as legislation, as not only legislation in the Senate failed, but we saw the market-based mechanisms embodied in a cap and trade demonized and by the opposition, and leaves us in a difficult spot and very uncertain about whether when the U.S. Congress comes back and seriously considers addressing this issue, what policy mechanisms are left, and if there'll be the leadership to revisit this policy mechanism, which indeed is a very important one. So I think another thing that Dr. Klein's paper shows is that there's really a pressing need for better information internationally to keep track of what other countries are doing, not just what they're pledging to do, but what they're actually achieving in common terms that are consistent across jurisdictions. Along these lines, I would differ a little from Dr. Klein's characterization of the ambition of China's intensity target. It's very much the future. The ambition of that is very much dependent on future GDP growth, and also, though it is a continuation of past improvements in emissions intensity, moving forward along the same ambition requires going for more difficult reductions in emissions. That is to say, a lot of the low-hanging fruit has been picked. Another important point is that business as usual in China actually accounts for and includes a substantial amount of policy in place for renewable energy deployment and efficiency investments. So the point is that business as usual can be somewhat misleading when that includes policies on the books and plans for making reductions that are already underway. In the spirit of enabling greater transparency and hopefully building a better, more political will and better understanding of what other countries are doing and building greater appetite for collective action, one thing that the World Resources Institute is doing, we're currently initiating what we hope will be a long-term project to track and report on each country's contributions to emissions abatement and international financing. There's currently pretty poor information from a number of countries, probably most countries, in terms of what countries are doing beyond just what they're pledging to do. And it'll be really important to have a consistent set of metrics that are credible for civil society, industry, and governments to really keep track of this complex issue. And of course, here is an area, I think, for some collaboration, transatlantic collaboration, and the expertise there is across the Atlantic. So speaking to the second paper, I wanted to, I think this paper I found refreshing. I thought it really highlighted some very big differences between the state of the debate in the European Union versus the conversation on global warming solutions in the U.S., and that more stringent policy could be considered beneficial, and in terms of driving innovation and creating opportunities for industry and business is a very refreshing perspective. It's not that the opponents of action in the U.S. have successfully defeated this opportunity that's out there, or defeated the clean energy jobs narrative, if you will, because there definitely remains a very compelling case that a lot can be gained by getting ahead in the clean energy race. And if anything, there's been some bipartisan consensus on that point. Of course, the question is how to get there. And clearly the sense of urgency is lacking in the U.S. Congress, and then they've just missed, of course, a very key opportunity to move forward and do something serious on this problem. And it's not for a lack of hearing this message. We've had the CEO of General Electric, Jeff Immelt, speaking, imploring really the U.S. Congress on a regular basis to set policies in place that will get investments moving into these low-carbon technologies. After the Senate really dropped the ball on this, there was a powerful, biting statement from Deutsche Bank in August excoriating the U.S. for being asleep at the wheel on climate change, explained why only, I think, $45 million worth of investment from Deutsche Bank is in U.S. clean energy products out of their $6 to $7 billion of investment in this space internationally. So we're really missing the investment money opportunity in the U.S. And this opportunity side of the equation, I think, will continue to be an important part of the political and economic debate. And I think there are likely areas for cooperation internationally in that space. I wanted to also comment on some of the lessons learned. I think I was working on Capitol Hill when Waxman-Markey passed and worked on the House bill. And there were certainly lessons learned. Some of the lessons learned from the European experience were taken to heart in the crafting of that legislation. Seeing decarbonizing the economy as an economic opportunity, as I've already said. Recognizing that there's a first mover advantage. If you take, for example, Germany, where the renewable energy market actually continued to grow through the recent recession, and the idea that if you're investing now in these technologies, you're creating space and opportunity for jobs, not just now, but in the future. I think another important point that comes from the European experience and was pointed out is that a price on carbon is not sufficient. It's definitely an important long-term signal, but as we're really talking about doing an energy system transformation here, there do need to be other measures, including research and development, public investment, and regulations that I think in large part just need to be removing barriers that exist. Where incumbent energy suppliers will really have an advantage and some barriers need to be removed, such as access to the grid and so forth. So I'd like to actually close my comments on something that Gunther really closed his comments on as well. I was thinking along the similar lines, I think. Not identical, but similar. Just commenting on a topic area where I think there's a lot more can and will really need to be done in terms of research and analysis, and in order to compel appropriate actions in the U.S. and internationally. And so when we talk about costs and opportunities associated with transitioning to a low-carbon economy, we're talking about the costs and opportunities of making energy system investments. But we really have to be mindful and not lose track of the fact that there are major costs associated with continuing on the path we're on, business as usual, or even insufficient action in addressing climate change. Speaking as a climate scientist, it's something that I obviously can't forget and try to implore others to keep this in mind. So the point is that really, I think we really do need better estimates of what the cost of inaction is. We don't have good estimates. Part of this is just we still need to understand the climate system better, but a lot of it is just a lack of communication between economists and climate modelers in terms of research collaboration. I know in the European Union, the European Commission, the Joint Research Center, has been doing research in this space, quantifying the costs of climate change at different degrees, temperature change, and what the impacts would be in the EU. Not a lot of work has been done on this in the U.S. There's been some, but it's really cursory, and even having good numbers for the U.S. and EU doesn't give us a picture of the global implications we're talking about, the complete loss and disappearance of island nations, the impacts of losing all of the glaciers in the Andes, and which are key water supplies for South American nations. These are important issues and I think good potential areas for research collaboration, the U.S. and EU government funded research moving forward. Thank you.
So thank you very much to the two speakers and the two discussants. What I think we should try in this discussion and before opening the floor to questions is to put what we're discussing in the broader perspective of the agenda for today, which is to discuss 4 areas of policy comparison and policy cooperation. What we're discussing now is probably the field in which is the most difference or divergence between the US and Europe. Because in other fields we're speaking of a move from joint action to some degree of differentiation, or we're moving, we have some topics for disagreement. Here we are at the risk of a major divergence. I mean, perhaps not only at the risk. I mean, we're speaking of different preferences that are being exposed. And so the question I would have are, first, what degree of difference we can accommodate and still trying to find fields for cooperation. At what point is it just becoming meaningless? The price of carbon is a good illustration, because the price of carbon, after all, is an indicator of the preference you have for reducing emission, for pricing this externality. If you price this externality at zero, then it's simply just not possible to find meaningful ways of cooperation. And the second is how much does this imply? What does this imply for what you emphasize in your second conclusion, the initiatives vis-à-vis the rest of the world? How much cohesion do we need between the US and the EU to be able, again, to have meaningful joint initiatives vis-à-vis emerging countries? As we all know, this is where most of the action is, in fact, in terms of future emissions. So this is absolutely crucial. Who would like to start? And maybe, Randy, I would add something for you especially, which is, you spoke confidently of the 30% target for the EU. How confident are you that the EU, whatever happens in the rest of the world, is going to stick to its own agenda and to even to go further to take into account the effect of the reduction in GDP?
Yeah. The last question is an easy one, so I can immediately answer. I'm pretty confident because it's not motivated by what the other parties will do here, but it's really motivated by it's in the own interest of the European Union to do it, thanks also to the fact that it's less costly now. But the belief is really that if we would go to 30%, we would be able to leverage innovation stronger and have our EU companies being stronger in developing competitive positions in these markets and a stronger driver of growth here. So it's in our own interest here, and that should us make us more confident here. On your first question, which is a much more difficult one, is what is the degree of difference that we can accommodate here? First of all, again, I would like to open up. It's not just transatlantic. It's really differences also with other areas too, and particularly also differences with policies in Asia and in China, particularly in Korea, which are much more targeted, almost industrial policy, industrial policies towards particular technologies like solar PV here. this gives me already one important point, which is indeed the problem that there could be indeed too much targeted policies here, where in general what we actually need is a general carbon price here, global price here. So on the incentive that comes from carbon price, there is actually not so much difference that we can actually accommodate here, when we would like to have as smooth and global carbon price as possible. But if you look at the other instrument, which is R&D financing, public funds for R&D, there we can accommodate a bit more differences here, because particularly this instrument is important in the early stages of development of technology, where it's actually very important that you stimulate various technology trajectories and allow for much more competition to still arise between these different technology trajectories here, and there is much more room for each country trying out different options here, but at least then in later stages coordinate, once it's become more clear which technologies will be more dominant, coordinate in those stages by coordinating on common standards, etc. But initially would allow for more differences here. But on the carbon price, there it's clear stronger signal comes from a global carbon price.
As you know, this country has gone backwards quite a bit from where it was just a couple of years ago. I think Hurricane Katrina sensitized the public that this is a serious problem, rightly or wrongly, I would say rightly. And in the election, we had two candidates, the presidential election, both candidates were committed to strong stands on acting on climate change. Now we have, climate is just another victim of the collapse into political gridlock. We heard this morning's session that there's doubts about the U.S. fiscal because there's greater challenges of getting credibility of political action. Well, this is sort of true in spades on climate. On the other hand, you've got a 40-year period here, and the main thing is to get the ball rolling. I think there's a lot can be. I was quite struck in the figure in Reinhilde's paper about R&D, public R&D. And I was not struck by the fact that it's there. I was struck by how small it is. It's 450 million euros. So, you know, I started looking, well, what are the corresponding numbers in the United States? Only $2.5 billion a year. So why isn't the kind of an area where we can move immediately to have, you know, sort of a joint initiative that, you know, we will undertake substantial upscaling of public R&D. The U.S. and EU will do something together on this. I mean, this, after all, was what the Bush administration pushed on climate change. You know, instead of abatement, is a focus on the R&D. So there are areas where you can start work. I also think that it's right that if you can, the more you can do to get the carbon price functioning, the better. And I was struck that in the Western initiative, the carbon price is only $2 per ton. Europe, it's running at 15 euros per ton. Well, why couldn't one, again, in Plan B, start making operational similar carbon prices in those initiatives? But we're really in a second or third best here. Now, that being said, I would say one more thing. I think the Europeans' proclivity to have, you know, absolute, you know, international treaty obligations is something that looks a little bit different from this side of the Atlantic. And particularly, I think it's a question of what, you know, what you're going to get China to do. On China, you know, you're definitely not going to get China to admit to agree to concrete targets by concrete dates. Bottom line, I think there are things that can be done, but, you know, we are in a very unfortunate situation, I think, in terms of the politics of this on the U.S. side. I will just on China note that the baseline that is in my paper is the Energy Information Agency's baseline, but I will also acknowledge that you know, when you look abroad and, you know, who's doing the wind turbines and who's doing these things, you know, China really stands out. So there's a little bit of a incongruity there, I acknowledge.
Thank you. Would any of you want to jump at this stage, or do we go to Q&A?
I'd be happy I'll make a quick comment. I mean, it's difficult to answer the question coming from the U.S. and how much difference can we accommodate. The question, it seems like it'd be better posed to the European side, because we're not moving forward, and Europe is, and even strengthening targets and taking on greater ambition. And I think it's just been instructive on the U.S. side, and at least the policymakers who are serious about this, to watch what the European Union's doing and try to learn from that and see that, ETS has been operational for several years now. The sky has not fallen. This is something we can do. I think that's beneficial to the discussion, but I think, as Bill rightly said, we're really less here in D.C. and on Capitol Hill looking across the Atlantic than we are looking across the Pacific or to other countries that we compete with in other areas. So it's a real challenge. It's a difficult question to answer sitting on this side of the Atlantic.
Well, okay, if the ball is so clearly played to me. In a sense, I have difficulty answering the question as it is, because when you ask what degree of carbon difference, price difference and so on can we tolerate, that's an incomplete question, and what it doesn't say is before we do X. Like what? Like before we do climate policy in the EU. I don't think we see that as an option. It's not like when we see, okay, the US isn't playing ball, so then we drop pursuing climate change policies. I don't think that's an option at all. It's just the bigger the difference is, the harder it will be. But the interesting dynamic in this is, of course, that everybody around the table internationally understands that ultimately this is in their interest. China understands what it means if Himalayan glaciers are melting and if they have drought problems, because they have them today. Or if the sea level is rising because the richest part of China is on the coastline. They understand that. But what you have seen, and what the complicating factor is that climate change, from being for decades an issue that was driven by people and countries more interested in it than others, in Copenhagen you saw the issue arrive at the top level, where it belongs. You had President Obama, you had Wen Jiabao, you had these people sitting in a room haggling over text. So the issue is now a top-level issue, and that's new post-Copenhagen. And so inevitably, of course, it gets bound up in all the other big issues that are up there, like who's going to dominate the planet in the 21st century. And that is why the axis China-US is such a huge elephant in the room in the climate negotiations. But it's also interesting to see how in other contexts one can see China. I've recently seen an article written by John Gummer, a member of the House of Lords in the UK, pointing out that China is actually preparing its own emissions trading scheme and having the beautiful sentence in there, given stasis on this issue in America and power shifting east, it is time for Europe to look east too. I think that's quite the wake-up call, isn't it?
Thank you.